Hi! So before I start, just wanted to wish everybody an early Christmas. By the time this video is going to be uploaded, I'm probably already on my way to China or already in China. So if I actually do stop uploading, you know what happened to me. Fingers crossed. Jokes aside, I know that many of you are big-time Chinese or Hong Kong investors as well, and I will be on a lookout. Definitely this is a leisure trip from me, so I can't confirm that I have an answer for all your questions, but I think especially for those businesses or companies with a physical presence, it's a lot easier for me to kind of keep a lookout of what they are doing and the crowd and just understanding the economics and whether people enjoy their products or not. So namely speaking, I think some of the big US names with great Chinese exposure like Starbucks, Lululemon, Nike, I'll probably be visiting their stores, give you some insights and maybe make a follow-up video after I'm back. On top of that, I think some of these Chinese names that a lot of you are looking forward to as well, Luckin Coffee, Yum China, Meituan, many of your EV brands, your BYD, your XPeng, your NIO, what's the distribution like, how many people are actually driving those cars, so on and so forth. In terms of the app-related companies, which is where most of us are invested in, I definitely wouldn't want to be prying into other people's privacy as well, right? So I think just to kind of give you some broad-based understanding about the usage of WeChat, Taobao, JD, Pinduoduo. I can try to ask people that I come into interactions with, but yeah, no confirmations as well. So, and last but not least, I think some of you are also interested in terms of the business and consumer sentiments. So I can't give you a full picture because I'm only traveling to 3 cities, but I'll try my best and maybe just give you some perspectives from there on. So with that aside, I think this video's main idea is still to share my investment reflection for 2024. So I think I'm just going to categorize that into 3 main categories that I'm going to share. Firstly, I think specifically for myself, over the past 4 years at least, when I'm investing, I think one of my largest lessons that I've gotten is really the idea of portfolio allocation. So I think for those of you who are OG followers since the start, 4 years ago, I think I was roughly 22 years old. I was 22, I was young, naive, and I thought that I can conquer the world. So initially, I didn't really treat portfolio allocation as something serious. And I believe most of you actually kind of chanced upon me because of my big bullishness or my favoritism towards this Chinese e-commerce company called Alibaba. And at one point in time, I was actually 100% all in into that company. Of course, back then, I didn't have a very big equity portfolio size, and also I wasn't necessarily working. So the size was pretty much something manageable. And back then, I really thought that I could just go all in into a company, 100% first, and as I incrementally put in capital injection, and as I work, I build up my capital size, I can start to allocate more money to other positions and to build a more well-rounded portfolio. But I think to my surprise, or at least based on the last 4 years of the bear market, my biggest conviction or my biggest position still have not kind of came into fruition. So that's one. I think secondly also, if I were to restart, I think the optimal holding for me to understand my portfolio of companies and still be comfortable monitoring them, to me at least now, is at least between 10 to 15 names. And if I were to do an equal allocation throughout, so 10 positions making up 100% of the portfolio, just means that it's 10% each. I think that should be a more suitable way in terms of portfolio construction, because I do kind of took away the reflection that I think companies should earn their keep in order to stay in your portfolio, and especially so those with a big or large percentage. So rather than saying that, oh, I'm going to allocate 50% because I think that this is a once in a lifetime opportunity, why not start 5%, 10% position and allow for the company fundamentals and the price action and the valuations to catch up, and then it organically grows from your portfolio. So from a 10% position, if it 3x, it 5x, everything all else equal, it will grow into a sizable sum. So rather than trying to rank it in terms of how big your conviction is, I think it's good to at least spread your bets out a little bit. And I think a lot of people will probably still argue that, hey, even having 10 positions at 10% each is still considered quite concentrated. So I guess it's really relative speaking, and it depends on your own investor profile. So the second lesson that I want to take away, or the second reflection, is the feeling of comparison. I think something I've somehow figured out along the way, over the last 2 years or so, is that sometimes a lot of us are not sad or disappointed or feeling lousy because our portfolio is down or because our performance is bad. In fact, if the entire market is bad, or if your friends and families are all not doing very well, and your portfolio is in the red, then I think you'll probably still feel better about yourself. So it's really back to the point of comparison is the thief leap of joy. And more so because you kind of lost to someone, even though nobody created this competition and everything is just in your mind itself. I think it's also especially important in this all-time high market where it's not just US equities that are at all-time high. You can see many different types of investors that cuts across many different asset classes. Many of them are experiencing great returns. And I think coming from somebody that has been invested in the Hong Kong market over the last 3 to 4 years or so, yes, some positions or some companies have already started to recover, but I think generally speaking, I think the mood and the sentiment is still quite bearish and people are still not very excited about it. So I guess you're kind of stuck there and you don't really know how to make do of this opinion or this emotion gyrating at the back of your mind. For myself, I think moving on to the third point or the third reflection that I have, which is also kind of interlinked with the second one, is that I think let's not forget that markets always move in cycles. And I've personally seen many people chasing the highs and also exiting the lows, regardless whether it's in crypto, in normal US investing. We have seen, I don't know why, but just economic cycles or just many of these stock market bull bust cycles, it's kind of compressed into a very, very short span in time. And just in the last 4 to 5 years, we have already experienced 2 bear market and 2 arguably euphoria market, if you consider 2021 and also today. So I think in this case, I think consistency is really the superpower here. And I think there's this famous saying that if you want to finish first, you must first finish. So I'll definitely be the first to admit that it's definitely hard to keep to one philosophy and to follow through, especially for the game of investing where the feedback period might sometimes be long. And I think over the last 4 years or so, you could say that it's a long enough time frame, but in fact I'll argue, in the grander scheme of things, it's still considered quite short. And until today, I always reflect and ask myself this question, whether this time is different and whether the philosophy or the fundamentals that we look into investing is different. It could be applicable to some industries or some companies or some geography, but maybe not so much of the Chinese market. And I'm still asking myself this question until today because I still have very varied results with the Chinese market. And as you all know, the broader market sentiments is still that when we start in a bear market, people are saying that in the US, you have long bull market trends and short bear markets. Chinese market, it's completely different, and you are basically now just stuck in a long bear market with no end in sight. But more so, I think over the years, I've kind of trained to be more numb and not to be too concerned about other people's performance. I'm trying to benchmark it against mine. So last part, I think I just wanted to have a bonus point here. I think that our brain always like to play tricks on ourselves and be mindful of what lessons you kind of take away, especially in this season of reflection. And just one important thing that I want to put out here is that this idea of recency bias. So I think I just wanted to share 2 different points of view for you to understand what I'm trying to say. Firstly, definitely both are coming from my own investment reflection and experience. Is that the first part is that maybe you take away the lesson of, holding on to high quality stocks, great compounders, allow them the time frame to compound your wealth. That's where you get your multi-baggers. And for myself, I think Meta is one good example. And it almost 3x even after averaging up, and I definitely did not catch the bottom for Meta platforms. So intuitively, it makes sense. Yeah, you want to hold on to good companies, you allow them to compound. On the flip side, I think a second point of view, also my own investment, which is into Adobe, it's that it's might actually be good to trim when stocks gets overvalued. And I'll share with you why. So personally for myself, I first bought Adobe in March of 2023 at around $340 per share. And from there on, I actually continued to average up to over $440 per share. So looking at the price action of how Adobe performed, actually Adobe rallied to the highs of $640 in February of 2024. And then it tanked down to $440 in May of 2024. And then it rallied back up to $580 in September of 2024. And then it came back down to right now under $450 per share. So sure, I think you can look at some of these online discussions and narratives. You can be trimming Adobe at $600, $700 per share because you might think that it's overvalued, and you can then add back when it's undervalued again. So this is definitely in the merits of hindsight bias because we won't know how stocks will perform, and if we constantly go through this process of constantly trying to trim, you never know when the stock just suddenly rally. And going back to the point of the Meta platforms, I do know of a lot of friends that bought into the lows of the 100s, 200s range, and they all exited after a 30-50% increase. And right now, they are definitely won't be seeing this sort of multi-bagger returns because they won't hold Meta until $500, $600 per share. So I think what, at the end of the day, can we learn from this? So for myself, I think that you should focus on the process and make sure that many of these incremental learnings or reflections that you get along the way are not oxymoronic. Because as I said, I think if you were to put the 2 case studies together, they kind of contradict in a way of each other. So here's how I look at these 2 specific examples, is that you only sell when they become super duper ultra overvalued, like to the point or to the extent where you yourself can't fathom a case where these companies can grow into that valuation. But if not, I think even if you use Adobe as an example, it could rally to $600-700. I think that yes, it might be pricey, but I don't think that we can argue that it's like extremely euphoric overvaluation. So from that point of view, that's how I kind of square the two different learnings together. And don't be too fixated on the idea of recency bias that, oh, just because you had a winning investment in Meta, that it managed to 6x from the bottom, even though I didn't manage to 6x. Maximum, I only took away 2.8x, but still, you might think that, oh yeah, buying into compounding stocks, allow for stocks to compound is the best. And then next year, when you suddenly buy into such compounding stocks and then they tank, and then you think that, oh, I should have took profit when they're overvalued. So that's just my own very short two sharings. And of course, if you guys have any of your own reflections, feel free to leave in the comment section down below as well. And with that, I'll see you guys in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye.